Welcome to ETF Leaders powered by the New York Stock Exchange. I'm Judy Shaw. Joining me today is Lance Humphrey, Portfolio Manager with Victory Solutions. Lance, thanks for joining me.
Great to be here. Thanks for having me.
So let's begin. Some investors are concerned with the high concentration in market cap weighted products. What would you say to these investors?
I would say that that's a concern that we share ourselves as asset allocators. We believe that really there's a false sense of diversification in many of today's market cap weighted indexes, which makes sense if we think about it. If you own 500 of the largest names in one of the largest and most vibrant economies, it sounds like you have a very well diversified portfolio, but what we find is really that there's a lot of concentration in those indexes. So for example, today, the top 10 names in the S&P 500 make up more than 20% of that index. The top 50 names make up 50% of the index. So what we find is that a lot of the names in those indexes really aren't contributing a lot to the risk of the portfolio. So we think that it's very important to look at a more diversified or a more balanced approach to investing in those core names.
You follow a volatility weighted approach. Tell me more about that.
So a volatility weighted approach is simply a way of building more diversification into an index. So I mentioned the 500 names before. Well, instead of having just the top largest names in that index driving the risk, what a volatility weighted approach allows for is for all of the names in the portfolio to equally contribute to the risk of the portfolio. So the top 10 names will provide the same amount of risk as the bottom 10 names in the portfolio. And we think that that diversification is really a critical element in today's portfolios.
Why not just equal weight?
So equal weighting is, I think, a step in the right direction from market cap. One implicit implication from equal weighting is that now the more volatile names will end up driving more of the risk. So for example, if we have a portfolio that contains, let's say Tesla, which has been a very volatile name here recently, or a name like Procter & Gamble, which is a very safe and conservative name, what will happen is if we equal weight those two names, Tesla really will drive a lot more of the risk of those two positions. So what a volatility weighted approach does relative to equal weight is we're going to make a slight adjustment. Those names that have more volatility will get a slightly lower weight, and the names that have less volatility will get a slightly higher weight. And again, all that does is now allows for all of the names to equally contribute to the risk of a portfolio.
What impact does volatility weighting have on FAANG exposure and tech more broadly? And are there any other sector exposure consequences?
Yeah, so if we think today, again, we think those largest names in the S&P 500, they tend to be concentrated today in the technology sector. So we think about Facebook or Apple or Netflix. We find that those names are very high relative to other names in the index. So what a volatility weighted approach will do is oftentimes it will be underweight the sectors that are the largest, most popular, and perhaps most overvalued. On the flip side, we tend to be overweight sectors that might be more undervalued or more or less represented in the overall market cap weighted indexes. So we find these approaches can look a little bit different from a sector perspective, but what we found over time is that those differences are a very important contributor to the overall returns and the risk reduction of the product over time.
Being an asset allocator, how do you position a volatility weighted strategy in an investment portfolio?
We think it serves as a very important core part of the portfolio. So in our own portfolios, we use these types of approaches as more than 50% of the portfolio. And I really think it could be 100% of a core portfolio, but then there's things to consider where we might be tactical in some of our exposures, where we might pair a volatility weighted approach with some in your ultra cheap large cap beta that allow us to be a little bit more efficient in trading. But we do think that this serves as, again, a very important core part of a portfolio, not just in the US, but in international emerging markets and small cap. Again, we think that that applies all the time, but even more so today, given that extreme concentration in several of those indices.
Lance, thank you so much for joining me.
Thank you so much. Great to be here.
And that's ETF Leaders powered by the New York Stock Exchange.